the returns you own that you will generate in stock come from three places: the dividend yield, the earnings per share growth, the change in the entry and exit multiple annualized over the holding period. A single family office. One very wealthy family, we managed their capital. So we took a pool of capital, like around nine figures, so millions of dollars. And then we would manage that and we would invest it into venture capital, private equity. One of the biggest family offices in the world is the Walton family office. You know, the founding family of the company you work for.
Oh, okay.
Right? And they have billions under management. Right? Another one is Cascade, and that's Bill Gates' family office. Billions under management, tens of billions. Usually in finance, one of the things that matters a lot is where you went to school. Investment banking firms you want to work for, whether they recruit from the school you went to. So this is generally the most important. The main thing that a firm is looking for in an investment banking analyst is you have to have a good background in accounting. You have to have a good background in financial modeling, in Excel. You have to be willing to work really hard because the hours are extremely long.
Hey Akshay, welcome to the podcast and thank you so much for agreeing to this one.
Yeah, thank you, man. I'm honored to be here.
Intro about yourself, Akshay, and especially since you are from Tamil background, I just want.
சரி, நான் வந்து இந்தியாவில் பிறந்தேன். என்னோட அம்மா அப்பா வந்து தமிழ்நாடுலேருந்து வருவோம். ஆனால் நாங்கள் எல்லாரும் 3 பேரும் நாங்கள் வந்து பாம்பேல தான் எல்லாரும் பிறந்தோம். அம்மா அப்பா வந்து பாம்பேல ஸ்கூல் போனால் படித்தா வேலை பண்ணினா. அப்புறம் நான் பிறந்ததுக்கப்புறம் 7 வயசில் நாங்கள் யூஎஸ்க்கு நாங்கள் போனோம். ஸோ நான் யூஎஸ்ல தான் நான் வளர்ந்தேன். ஸோ என்னோட பாடி வந்து இந்தியன், என்னோட மனசு வந்து அமெரிக்கன்னு வச்சுக்கோங்க. யூஎஸ்ல ஸ்கூல் போனேன், படித்தேன். அப்புறம் என்னோட பேக்ரவுண்ட் வந்து நாங்கள் வந்து யூஎஸ்ல வந்து ஒரு நெய்பர்ஹுட்லேருந்து இன்னொரு நெய்பர்ஹுட் போனாக்கா ஸ்கூல் வந்து ரொம்ப டிஃப்ரெண்ட்டாக இருக்கும். ஏன்னாக்கா எப்படி அந்த ஸ்கூல்ஸ் எப்படி ஃபண்ட் பண்ணுறா யூஎஸ்ல வந்து இட்ஸ் பேஸ்ட் ஆன் அந்த ப்ராப்பர்ட்டி டேக்ஸஸ். ஸோ நிறைய பைசா இருக்கிற பேரோட நெய்பர்ஹுட் வந்து அந்த நெய்பர்ஹுட்ஸ் வந்து ஸ்கூல்ஸ் வந்து ரொம்ப நல்லா இருக்கும். அண்ட் அவ்வளோ பணக்காரம் இல்லாமல் இருக்கிற நெய்பர்ஹுட்டில் வந்து ஸ்கூல்ஸ் அவ்வளோ வந்து நல்லா இருக்காது யூஎஸில். ஸோ நாங்கள் வந்து அங்கே இந்தியாவிலேருந்து யூஎஸ் இமிக்ரேட் பண்ணினோம். ஸோ நாங்கள் வந்து மிடில் கிளாஸ். ஆனால் நான் வந்து ரொம்ப நல்ல ஸ்கூலுக்கு போனேன். எனக்கு லைக் த வே த ஸ்கூல் டிஸ்ட்ரிக்ட் வாஸ் ட்ரான், there was like this small part where the houses were cheaper and I got to go to the nice school. Okay. It's just like luck knowledge. Yeah. Okay. So now என்னோட ஃப்ரெண்ட்ஸ் அவளோட அம்மா அப்பா எல்லாரும் லைக் ரொம்ப லைக் பணக்கார பீப்புள் வந்து. அண்ட் என்னோட ஃபேமிலி வந்து லைக் நாங்கள் I mean like we weren't poor but we weren't like wealthy, so money was always typical US immigrant மாதிரி. ஆனால் என்னோட ஃப்ரெண்ட்ஸோட ஃபேமிலிஸ் அவெல்லாம் வந்து யூஎஸ் வந்து 20-30 years முன்னாடி வந்தோம். ஸோ அவள் லைக் they were more successful, more established, right? And so இதனால நான் ஆல்வேஸ் நான் திங்க் பண்ணுறது லைக் how do I எப்படி மோர் லைக் பைசா பண்ண முடியும் அந்த மாதிரி என்னோட மனசில் ஆல்வேஸ் இந்த இது இருந்தது. எனக்கு நிறைய டைம் லைஃப்பில் வந்து பைசானால சில சாமான் பண்ண முடியும் அண்ட் சில சாமான் பண்ண முடியாது இல்லையா. Like money buys you freedom. So for me like money was always an important topic, so நான் ஸ்கூலில் வந்து நான் ஹை ஸ்கூலில் அவ்வளோ நல்லா நான் படிக்கல, கொஞ்சம் ஓகே நான் பண்ணினேன். அப்புறம் நியூயார்க் யூனிவர்சிட்டிக்கு நான் காலேஜில் போனேன். But when I got to NYU I had very much of a mentality of I want a high income job. நிறைய பணம் பண்ணுற மாதிரி வேலை எனக்கு வேணும். அதனால தான் எனக்கு வேலைக்கு போகணும், right? And because that was my interest, right? So I didn't have like medical school, law school அந்த மாதிரி எனக்கு அவ்வளோ இன்ட்ரெஸ்ட் இல்லை. எனக்கு மெயினாக வந்து like how do I get to financial freedom? That was the main thing I was solving for. And the clear answer is like either company start பண்ணணும் இல்லாட்டா ஃபைனான்ஸில் போய் வேலை பண்ணணும். These are like the two most efficient. இப்போ வந்து I think ஒரு மூணாவது ஆப்ஷன் இருக்குது which is enterprise software salesல போனாக்க அதில் like it's like a lot of money early, you don't need a graduate degree. Okay, so those are like kind of three paths I found. And so, or like if you want to go work for like a big investing firm, like where institution or paisa allocate பண்றதுக்கு, you have to start in investment banking. Investment banking, investing வந்து same thing கிடையாது, almost opposite இந்த ரெண்டு வந்து. Investment banking வந்து கம்பெனிக்கு அட்வைஸ் கொடுக்குற ஜாப் வேலை. So it's more like sales. Okay, so it's like you have to make very nice PowerPoint slides, and you know, ஒரு கம்பெனி வந்து இன்னொரு கம்பெனியை வாங்க போறோம்னாக்க அந்த ஹோல் இது டிரான்சாக்ஷன் ஃபெசிலிட்டேட் பண்ணுறது வந்து இன்வெஸ்ட்மெண்ட் பேங்க். ஸோ வீடை செல் பண்ணுறது பை பண்ணுறதுக்கு வந்து புரோக்கர் இருக்காங்க, ரியல் எஸ்டேட் ஏஜென்ட். இன்வெஸ்ட்மெண்ட் பேங்கிங் வந்து அதே வேலை, ஆனால் வீடுக்கு பதில் கம்பெனி. ஸோ you're dealing with bigger numbers, but it's the same concept. Okay, so I did investment banking after college, and then I went to a family office, right? So now I'm in investing, right? So the first job was sales, the second job is research, right? In the company on the 10 வருஷத்துல, you know, is it going to be 10 times bigger or is it going to be bankrupt, right? How does the company make money? Like what customer க்கு என்ன problem solve பண்றா, அந்த மாதிரி question வந்து that's what an investor does, right? So நான் என்னோட company வந்து பேர் வந்து like a single family office. So one very wealthy family, we managed their capital, right? So we took a pool of capital, like around nine figures, like hundreds of millions of dollars, and then we would manage that and we would invest it into venture capital, private equity, private credit. But my time was mostly spent on stocks, right? Public equities. And we ran like very concentrated portfolio, like, you know, 5 to 10 stocks that we would think about owning for 5 to 10 years, right? It's a very different mentality from what most people follow in the markets, because most people market in the stock next month enna panna poradhu illa next varsham enna panna poradhu, and they always think in terms of the stock and not the business, right? So the philosophy we used was forget the stock chart, but focus on the business. What problem does the business solve for customers? How does the business make money? Can the business defend against competition? How much bigger or smaller can the company get? You know, what are the estimated annual returns, and what's the overall risk versus reward, right? Because there's always uncertainty and risk in investing. So those were like the 6 questions we were trying to answer, and it was amazing. You know, I got to read and think all day. You know, one of the main issues in your 20s is you don't spend a lot of time reading and thinking. In your 20s, when you start out as an entry-level job, you just have to create deliverables for other people in most industries, right? That's the way it works. And then as you get into your 30s and 40s, then you start to read and think, and as you climb the corporate ladder, you become less of a worker bee and more of a thinker bee, right? So I early on in my career, like right after I did my investment banking gig, I realized I have zero interest in. So anyway, so early on in my career, I realized I had no interest in being a worker bee, and I wanted to be a thinker bee, right? Like I did not want to spend my 20s making deliverables like PowerPoint and Excel and stuff. I wanted to spend my 20s thinking. So I had to make a trade-off, right? The trade-off I had to make was in the பெரிய name ஓட மாதிரி firmக்கு I have to give up prestige for my day-to-day, if that makes sense, right? Like I can go to like a big prestigious firm that everyone's heard about, but then in my 20s I'm going to be creating a lot of deliverables and I won't really get an opportunity to think and develop as an investor, right? But if I go to a place that's less known, I'll have more responsibility earlier on.
Right.
And ultimately I realized like that's what's going to make me a better investor long term, because it'll make my day-to-day better. காத்தால வேலைக்கு போறது மனசுல வந்து ஹாப்பியா இருந்ததுனாக்க நிறைய வருஷம் வேலை பண்ணுவேன். ஆனா காத்தால வேலைக்கு போறது மனசு வந்து ஹாப்பி இல்லைன்னாக்க ரொம்ப கஷ்டமா இருக்கும்.
கன்ஃபார்ம். நான் ஆக்சுவலி ஐ கம்ப்ளீட்லி அக்ரி வித் யூ. பட் இதில் ஒரு கொஸ்டின் ஆக்சுவலாக சி
Yeah.
பெரிய கம்பெனிஸ் போகிறது வந்து ஒரு ஸ்டேபிளான கரியர். ஆனால் ஒரு ஸ்டார்ட் அப் இல்லை ஒரு நாட் ஸோ வெல் நோன் பிராண்ட் ஆர் ஒரு சின்ன ஃபண்ட் ஹவுஸ்க்குள்ளே ஒர்க் போகிறதுங்கிறது தான் லேர்னிங் அதிகமாக இருக்குங்கிறது எவ்ரி ஒன் நோஸ். பட் நாட் ஆல் ஸ்டார்ட் அப் டஸ் தட் இல்லையா? இல்லைன்னா whatever fund house that you entered, like you said it's a family office investment something. So if you should, I think you should definitely explain what it is. And second thing is, how would you identify such kind of a family office or like very not so well known company where someone can get into a job? Because usually a fresh graduate would look for something like பெரிய companies தான் நமக்கு தெரியும் இல்லையா? இதெல்லாம் எப்படி கண்டுபிடிச்சது அப்படி?
Yeah, so you're absolutely right. I mean, the risk trade-off இருக்கு அந்த மாதிரி. இல்லையா, எனக்கு நிறைய ஸ்டார்ட்அப் போகிறது வந்து they fail many startups, right? So நான் காலேஜ் விட்டதுக்கு அப்புறம் I went to a mid-sized company. So yeah, so பெரிய கம்பெனில சின்ன கம்பெனில but a mid-size, like stable company where I could learn. அங்க வந்து நான் ஒரு வருஷத்துக்கு வேலை பண்ணினேன். அதுக்கப்புறம் நான் ஃபேமிலி ஆஃபீஸ்கிட்ட போனேன். See, family office வந்து it's a very unique opportunity because actually there's a lot of stability in a family office, right? Because the capital is permanent, right? It's just one limited partner that you're managing the pool of capital for, right? Versus a smaller hedge fund, the limited partners can pull their capital if you perform poorly, right? At a family office, it's permanent capital, so it's less risky actually because of that. Now, as the investor in the family office, if you do poorly, you will get fired, right? But you get a longer kind of leeway than you would at a hedge fund, right? So how I found the opportunity was just through a friend, right? Because I had been involved in a couple of investing organizations. So நான் காலேஜ் பொறுத்து 2 இந்த இன்வெஸ்டிங் ஆர்கனைசேஷன் இருந்தது ஸ்கூலில் வந்து. And அதுலேருந்து எனக்கு நிறைய I had a lot of mentors and friends, and so I had like a lot of a big network of people that I exchange investing ideas with and people that I earned the respect of because of all the work I put in the prior years. So it was really just through a friend that I got the job.
Looks like networking played a huge role here அப்படின்னு நான் நினைக்கிறேன். Because
yes, but I would say like the one thing is like it wasn't really networking per se, right? Like for me they were just my genuine friends, right? Like the mentor that I got a job with that like helped me get both my jobs after undergrad. Like I went to a music festival with him in Austin, Texas, right? So we were like brothers, you know? So that's why, like, there was a lot of like warmth in our relationship and a lot of like mutual love and respect for each other beyond the kind of soullessness that can be networking.
Yep.
You know?
And one thing ரொம்ப இன்ட்ரெஸ்டிங்காக இருந்தது வந்து in the term correctly, if it's a family office அப்படின்னா I thought the entire asset under management வந்து maybe it won't cross like 10 million because I thought it's a private family, so it won't cross like 10 million. But from whatever you said, looks like the AUM is huge. So I think should be more than that.
So actually, if you have 10 million of assets, I think that would be a little difficult to start a family office. Because you have to have an actual office, and you have to have back office staff like the controller, the chief financial officer, like someone that does like, and a lot of people that do administrative things like taxes and stuff like this, So I don't know what a good rule of thumb is for a minimum level for family office, but if I had to guess, I would say at least like $20 or $30 million, right? And family offices can get really huge. Like for example, one of the biggest family offices in the world is the Walton family office, the founding family of the company you work for.
Oh, okay.
Right? And they have billions under management. Right? Another one is Cascade, and that's Bill Gates' family office. Billions under management, tens of billions, right? All these big CEOs, they have their own family offices. I think Jeff Bezos is called like Bezos Expeditions or something like this. Larry and Sergey from Google, they have their own family offices. They all have their own family offices.
It's a different animal, it seems like.
Yeah.
Maybe people out of finance, it sounds very new to us, but if you're from finance, maybe they will understand this better.
It's becoming more of a trend, like like when I was an undergrad, it still wasn't that popular to go work at a family office. Because generally what family offices would do is they would take the capital of the family and then they would allocate it into other fund managers. See, அவ வந்து direct investment பண்ண மாட்டாங்க. Usually family office only. Nowadays, more and more family offices, they're starting to do direct investments. So they pick the stocks. They pick the private businesses to buy, you see. And those family offices attract a lot of thoughtful investors that beginners can really learn from, right? So that's what attracted me to my role, was just when I spoke with my boss, he was just brilliant. You know, I learned more from him in the like few hours that we spoke during the interview, during meeting him socially, and then also during the interview process than I did like weeks and months on my own. You know, so I was like, hey, boy, this is a person I can learn from.
Okay. Actually, and the another question which I had was like, from my own experience, see, I've been spending time on investments or the stock market and public markets since I was like an 18-year-old. Nothing worked out. It was my experience. But then I kind of like almost I thought of giving up. Investing la, there's nothing. Then I came to a realization that when I start making money, to say it obviously, like when I crossed my first $100,000, right? Then I started realizing the power of compounding or investments and everything. Then it started showing me some results. So, do you still agree? And the first salary, or I would say like a person like me, please don't spend most of your time learning investments. Just focus on your career and increase your initial corpus by getting into a good job and salary. I think that had worked well in your case as well. Like நீங்களுமே எனக்கு என்னமோ நான் உங்கள் வீடியோ கூட பார்த்தேன், லைக் ஃபேமிலி ஆஃபீஸுங்கிறது வந்து ஒரு இட்ஸ் நாட் அ நார்மல் ஜாப். லைக் ஐ திங்க் யூ said like somewhere around like mid 6 figures. That's why it worked out well for you to retire early. So something along those lines.
Yeah, I agree. Yeah. It's good to have a high income job earlier on. That obviously goes a long way. That being said, even if you have a job where you make less than $100,000 a year in pre-tax income, after a couple of years, you should have some savings, you know, like $20,000, $30,000 in savings, right, at least. And you would be surprised how little capital it takes to acquire a small business. You know, I can't tell you what the landscape is like in India, but in the United States, you can acquire small businesses oftentimes for zero to very little money down, and you can structure the acquisition in terms of earnouts. So you go to like a founder that wants to retire and sell his business that he's run for like 20, 30 years, you know, a car wash, a laundromat, an accounting firm, a beauty salon, any of these kinds of small businesses, right? And you say, look, I don't have a lot of capital right now. And what you do is you can get a loan from the Small Business Administration and fund maybe 80% plus of the purchase price in debt, the same way you would with a house. You know, you don't pay cash for a house, you get a mortgage, right? In the United States, right? In most countries, right? And then of the actual down payment that you have to put down for the business, that should be a much lower amount. But even if you can't afford that, you can structure that in terms of earnouts. You can say, look, over the next year, as long as the business hits this metric, I'll pay you this percentage of profits for the next 2-3 years, whatever it is, right? And so if you have a lower income job, then that's the approach I would take. I would accumulate some savings, $20,000, $30,000, $40,000, and I would think about buying a small business. Now, that's also, it's not risk-free, right? Because you're taking on a lot of debt in order to buy the company, and if the business fails, you will still owe the debt, right? So you have to be really thoughtful about what kind of business you get into, how you analyze the business. So it takes some work beforehand, before you just go in and do it. Ideally, you should have at least one mentor to help you through the whole process. And there's so many online communities nowadays whether you're doing this in the US, in Europe, India, wherever, to learn this skill to get more income in the beginning.
Okay. And actually, like most of these subscribers for my channel, like they're all like very early, like people who are in their early 20s or who are just out of their college. Even yesterday, like I got a comment from one of my viewer. He asked like he just completed his finance bachelor's. Okay, so what are the skills or resources that he needs to hone in so that he can get his first job into finance, especially investment banking? So
Right.
anything.
Usually in finance, one of the things that matters a lot is where you went to school, and whether the investment banking firms you want to work for, whether they recruit from the school you went to. So this is generally the most important thing. Now, it's not the end of the world if you go to a school that investment banking firms do not recruit from, because there's lots of online programs to learn financial modeling. And so you can pick up some of these skills on your own, and then you just have to send a lot of emails. You have to cold outreach to like hundreds of people and explain that, just a quick background on your story, like who you are, why you're interested in investment banking, and if, they can speak with you on the phone for 5-10 minutes, and then you ask kind of advice in terms of, how they enjoy their job, or just any conversation about what they do and how you like what skills are necessary, and then you ask if they're looking to hire. Okay, and if they say no, then you ask if they know anyone else who's looking to hire, and you maintain the relationship. You follow up. You send something like a thoughtful note or something like that, and then you keep doing that. Eventually, you will get some interviews, and generally in the interviews, like the main thing that a firm is looking for in an investment banking analyst is you have to have a good background in accounting. You have to have a good background in financial modeling, in Excel. You have to be willing to work really hard because the hours are extremely long. Okay? And you have to have a good attitude because a lot of the work you'll be doing is, at times, it's going to get really frustrating, right? Sometimes the lawyer will email you at 2 a.m. to change something in the footnote in the PowerPoint presentation, right? If you have the mental disposition to throw your laptop across the room, it's going to be very difficult to do that job, right? Because it's just a lot of grinding, a lot of work. It's a little bit like, going through like Navy SEAL training a little bit, except for a white collar worker, right?
Sounds
Like
like
you
a
have to.
fang. Sounds like a fang job to me. Like எனக்கு டெக்னாலஜியில் தான் இப்படிலாம் நான் அமேசானில் இருக்கும்போது ஒர்க் இவ்வளோ லோடு இருக்கும். பட் நீங்கள் சொல்ல ஐ தாட் ஈவன் இன் ஃபேமிலி ஹவுசஸ் the work will be this much.
No, family office. I mean, it depends from one to another. But the one I was at, it wasn't. There was no. So the reason that investment banking analysts make so much money is because you're always on call. You always have to be available, right? It doesn't matter. You put Diwali, later 4th of July, later New Year's, you're always on call. Email vandadunaka odane respond பண்ணணும். This is why they make a lot of money, because you're always on call. So actually, the hourly rate calculate பண்ணாக்க அவ்வளோ பைசா இல்லை, right? Because you work a lot of hours, right? So those are the skills you need, and you just have to be willing to work hard and have a really good attitude and willing to learn. But the key thing, once you get the job, the key thing is to not make mistakes. So you have to just double check and triple check every piece of work, right? No spelling mistakes, nothing. You have to, when you get, basically what happens is you get PowerPoint presentations and Excel models that you have to prepare and polish and refine, right? And whoever you're reporting to, like the associate, the vice president, the managing director, they give you work, and then you format it or you create it, and then you send it back. And you have to send it back with no mistakes. That is what helps you succeed as an investment banking analyst. And then
Sorry,
Yeah.
any certifications or like a CFA?
It's CFA is not. I mean, it might be helpful if you don't have if you don't go to one of these universities where a lot of investment banks hire from. It can help you kind of just have a line item on your resume to get some credibility. But generally, the things you learn as a CFA, they're not so relevant to what you do as an investment banking analyst, right? What matters most is just like your horsepower, like your ability to work 80, 90, 100-hour weeks, right? And your ability to not make mistakes, like your ability to like check things, and a lot of the tasks you will have to do will be menial tasks. Like there'll be like a PowerPoint slide where the mid-level or the senior level banker will make a bunch of edits, and then you have to go in and like make those edits, and you have to make every single one, and then you have to turn it in, and then they'll go back and they'll make more edits, and then you do this like many, many times. You might spend your whole weekend doing just this, back and forth, right? And you like you have to have the stomach for that, right?
Yep.
It's an acquired taste. It's like sushi, you know.
Yep. Switching from career perspective இருந்து like உங்களோட investment journey, like especially like when did you start saving? Hopefully like you would have had a student loan இருந்திருக்கும் எப்படியும், but I hope so இருந்திருக்கும்னு நினைக்கிறேன், I believe so. அந்த investment journey எப்படி இருந்துச்சு, and then like especially how did you handle like post COVID? Because I've seen like people seeing a crash during COVID, and then like who handled it well, came out really well, and that paid off. So how did that happen? Or
Yeah, that's like exactly my case. என்னோட ஜேர்னியில் வந்து நிறைய லக் இருந்தது. Because I was still at the family office during COVID, and our fiscal year ended in February instead of December. So I got my 2019 year-end bonus 1 week before the stock market crashed. Okay, so I had like a lot of money in my account when everything was going down. Okay, and it's like there's like another layer of luck, right? Because I wanted to invest everything on that first day, right, on the Monday, but JP Morgan Chase had a $25,000 wire transfer limit every day. So I couldn't put my entire bonus into the market on one day.
okay.
But what ended up happening was the market kept going down. So because of this stupid wire transfer limit, I was able to average down. You see?
Okay.
Otherwise, I would have probably taken on the first day, and the market crashed a lot more on the second and third day. I think it bottomed, I think, on like Wednesday or Thursday. You see, so it's there is luck. You know, there's a lot of luck. You know, the best you can do in investing, I think, is like maybe 60% skill, 40% luck. You know, and maybe you can call luck karma, but there is this like X factor that you can't quite explain.
All in one stock?
Not in the beginning, but now my entire net worth is in one stock. But I do not recommend that to people. You know, that's like it's just because my life situation is very unusual. Okay, it's because I made money as an investment professional in New York City, right? So my income was very high. And now I study Buddhist psychology, meditation, and philosophy in India. And my cost of living now is very low. Okay, so my annual cost of living is like 3-4% of my net worth. So because of that, I can take a lot more risk, right? For example, tomorrow, tomorrow's Sunday. So on Monday, Carvana, let's say Carvana goes to zero, right? That's the company that my entire net worth is in. If Carvana goes to zero on Monday, I'll be fine because I think I have maybe like a 60% probability I can go back to the previous job I was doing. Or if it doesn't make sense for them to hire me back, I can go back to the United States. I have a US passport. I can drive a truck in the US for 2 or 3 years, and I can come back to India and resume what I'm doing, right? My cost of living now is like maybe $10,000 to $20,000 a year. If I really wanted to, I can get that down to like 6,000 a year.
Yeah.
Right. So financial freedom is not about just the net worth number. It's this ratio, right? It's a ratio of your kind of long-term steady state cost of living divided by your net worth, right? It's a little bit complex in your 20s because at some point you'll get married, at some point you'll have kids, right? Like in my case, like at least for right now, my plan is not to have kids, right? Like me and my partner, my girlfriend, like our plan is more to dedicate our lives to spirituality, right? So that means that there's more kind of predictability in my cost of living over the next, 30, 40, 50 years, however long I live, right? So that's why. So there's a lot of like strange aspects about my life that wouldn't apply to most people, right? Like I also have a very high income skill, right? Like I went to like a top school in the United States, right? I graduated with a high GPA. I worked at like prestigious firms. And so it's not as difficult for me to get a job because of those things. So that's why I manage my risk differently, right? Like the way you manage your risk is a deeply, deeply personal thing. It really depends on your life, your circumstances.
Now the market is doing really good. Like, how do you advise for people like us who could exactly kind of mirror what you've done before? Meaning, what if a next crash comes? Should I pull my money out of the market a bit and then like maintain some cash position so that I won't be gasping for money when the market goes down? Or better be 100% fully invested like some great investors do? But yeah, how to handle if a crash happens and how would you do it if you were to do it again?
Yeah, so again, it really depends on your circumstances, right? If you are continuing to generate income every year, like if you have a job or a business, and you'll keep buying some stocks every month, right? Like from your retirement account or something like this, right? Like you take a certain percentage of your income every month and you keep buying stocks, right? If that is your situation, it doesn't really matter so much that we're at a market peak because you'll buy now and you'll buy when it's down and then you'll buy when it goes back up and then you'll buy when it goes back down again. So you just keep buying and then you don't really think too much about the account, and then 20, 30 years later, there'll be a lot of money in the account. You'll do really well over a long term, right? So, but
if I maintain a big cash position, I would be able to like நிறைய stock வாங்கிடலாம் இல்லையா crash ஆகும்போது?
You can, but you don't know when a crash is going to happen. That's the problem, right? Like a lot of people thought there was going to be a crash in like 2013, and they had to wait like 7 years for the crash, right? And so you miss out on all of that compounding. And then, maybe it's like here in 2013, okay, and then in 2020, it goes up to here, and then it crashes to here. And then it goes back here. You had no chance to if you're waiting for that crash, you just missed out on 7 years of compounding, right? So that's why it's much more challenging if you're just putting a lump sum into the market and you will not be generating income anymore. That's a more difficult situation to be in, right? But I would assume most of your audience will have jobs and they'll continue to keep buying every year, right? Yeah. In that case, it doesn't matter so much that there's a stock market crash or anything, right? Like when you think about it, and it also depends on what type of investor you are, right? If you are genuinely interested in researching companies, okay, and you actually want to actively manage your portfolio the way that you do, right? You want to read books about investing. You want to read company filings, right? Like you're curious, like this is something that it genuinely interests you, right? which, by the way, the benefits of that are immense, right? Like, even if you're working, in a corporate job, being an investor, you learn how to think like a CEO that owns his entire company. That is a very valuable skill for you to develop to climb the corporate ladder and increase your income generating ability, right? You just start thinking of different ways to optimize the business, grow the business. You start thinking about the risks, kind of like where's the weak sides of the business that you're working for, right? And you will become a 100x contributor at your own company, right? So if that's your mental disposition, then you should spend a lot of your time thinking about businesses, okay? And not just like value, like not just businesses that trade at like a cheap multiple, but you should think about broadly, like all the way from startups, all the way to mature companies across all industries. You should just become like a sponge and just read and think as much as you possibly can about business models. And that's ultimately what will make you a good investor, not following the news every day or following like macro events, right? I think Peter Lynch, he's like one of the great investors of all time. He said something like, if you spend 13 minutes on macroeconomics, you've wasted 12, So it's more about just the fundamental business, like what problem is it solving for customers, right? Like, why does this business exist? Like, how can it solve more problems for customers? What does the growth opportunity look like? Those are the things you should think about. And also, it'll help you not only contribute more to your company, it'll not only help you compound your wealth at a faster rate, but it'll also help you create business ideas that potentially you can also start, right? So, and on top of all of that, it'll just make you a better thinker, and the training it gives your mind, you can use that logic, that thinking, that ability to do research in any other pursuit. For me, it's been transformative because, for me, like what I'm doing now, like studying Buddhist psychology, philosophy, and meditation, it's very much like research oriented. It's like, what is the ultimate nature of this, this video game that we're all in? Like, what are we all doing here? Like, how does this work? Like, how does the mind work, right? Like, and then one person proposes one thing, another person proposes another thing, and then one third person proposes another thing. And like, you have to read like all of them and then kind of like think about like, okay, if this person is right, what else has to be true? Okay, so it can't be that because then there'd be a contradiction. Like, you know what I mean? Like, you have to think like logically and resolve contradictions between different like texts and different philosophers and things like this, and then take those insights and then you go and you meditate on those things, and then that will help you kind of, for me, that'll take me to the rest of the end of my life, is
Yep.
contemplating on the ultimate nature of reality and meditating on it, to go into my mind and to see where suffering and happiness comes from, and dissolve the sources of suffering, these negative states of mind like anger, attachment, pride, jealousy, and those things, and cultivate the happy states of mind, right? Like, love, compassion, wisdom, patience, generosity, those kinds of things, right? So I can't, like, the benefits of thinking about companies and researching them is immense.
Yep.
But to the extent that someone has no interest in that, just buy the index, and you just keep buying the index.
Yeah. Yep. Yeah.
Yeah, and you should be willing to wait. You should be
Yeah.
patient you should be patient with yourself, because it's going to take many years,
Yeah.
since you don't have as much time to dedicate. But if you read the right books early on and you follow the right people on social media, right? Generally with investing, you want to follow like the old, boring rich guy, not the like young, I don't know, like the young like influencer trying to like. Yeah, generally that's like you want Warren Buffett, not some like crypto influencer, right?
Got it.
Follow the boring old wealthy person.
Still works.
Yeah. There's a reason they've lasted for so many cycles, right?
So, really wanted to understand like what you've learned from the family offices or from your investment banking background that we general public or investors does not know, like what kind of a process that they follow to get into an investment, like how long does the process take, like what kind of resources that they go into, and like how that have shaped your personal investment journey as well. Like, can you teach us about that?
Yeah, I think there's two broad categories, right? It's going to sound overly simplistic, but I promise you it's profound and not very many people practice it. The first category of things is what not to do, and the second category of things is what to do. Okay, so what not to do as a retail investor is trade, like to be like short term, right? And the reason for that is quantitative hedge funds are going to annihilate you if you trade, right? Because you're trading against a computer, right? I don't know if you follow the news, but recently this American quantitative hedge fund, Jane Street, has been in a lot of trouble, right? I don't know exactly like the context as for why they're in trouble, right? I don't really follow the news that much, but I have friends, a lot of friends in the industry, and a couple of years ago, I was at a wedding in Singapore, and I heard from one of my friends that Jane Street prints like billions of dollars, basically risk-free, doing market making in the retail options market in India. Okay, it's basically a direct wealth transfer from the Indian middle class to this like New York hedge fund. Okay, it's because these guys run these like options trading seminars and things like this. Like that is not like a good way to make money. Like those guys are not in the Forbes 100 wealthiest people. Okay, the people that are on the Forbes, they're generally entrepreneurs and they're definitely long-term investors. Generally long-term investors like Warren Buffett, Carl Icahn, Steve Schwarzman, right? These kinds of guys, right? So do not trade because you will lose that game long term, right? And the two books I would recommend to understand how this game works and why it's rigged against you, the short-term game, is Flash Boys by Michael Lewis and The Man Who Solved the Market. I forget the author's name. It's like Gregory something. It's about Jim Simons, the founder of Renaissance Technologies. If you read those two books, you will be terrified of, trading short term in the stock market as a retail investor, because you'll understand like why there's like hidden forces that are very much stacked against you, right? So that's the first category, what not to do. This is what people in the industry understand. They understand who owns what territory of the market. They understand that like the quant firms, they own the quantitative hedge funds and the high frequency hedge funds. They own the short term game, and they stay out of that game, right? So one of the big things is how to like not lose money in that, and one of the main ways is to not do that. Even if you want to trade quarters, right? Like that's like medium-ish term investing, right? Like you think, D-Mart or Walmart is going to beat the next 2 quarters on the earnings estimates. Even that game, you shouldn't play that game, because the hedge funds that do play that game, like Citadel, Point72, Balyasny, Millennium, they spend tens of millions of dollars getting credit card data. They have satellites that scan the parking lots of of stores to forecast how big of a quarter it's going to be for them, right? And then they pay experts like thousands of dollars an hour to understand like really specific like dynamics of the industry, and it's just going to be very difficult even to play that game, right? So those are the two things, like what not to do. What to do is to think long term. Think like 5 to 10 years out. Is this company going to be much bigger than it is today or much smaller than it is today? And then to understand that like some basic formulas, there's some underlying math and some formulas to understand about investing. To understand these formulas, all you have to do is follow Professor Damodaran from NYU, Damodaran. Okay, he has a course on accounting and a course on valuation, right? So then once you understand the formulas, then you'll understand like, okay, just because I think that Dmart will triple the number of locations it has over the next 10 years doesn't necessarily mean that it's a good stock to buy today, because a lot of that might already be priced in, right? So to understand like how to take your view of what the world will look like in 10 years and then convert that into what the estimated returns will be for a stock, you have to know these formulas. And they're not like terribly difficult, right? Like, if you're an engineer or like a doctor by background, like these formulas will be fairly simple for you to pick up. You just like go through the materials, like all his stuff is online. A lot of it is on YouTube, a lot of it is on his website, all the slides, everything he posts online. So understanding the math is very important, right? Another skill is you have to be really good at research. And so there's a lot of psychology behind this, right? Oftentimes, I don't know what the political climate is like in India, but in the United States, it's very divided, right? If you have a certain, like you're either like a Democrat or a Republican, and if you're a Republican, you watch XYZ news channels, and if you're the other party, you watch ABC news channels. So it creates these echo chambers where people look for evidence for the view that they already have. And then they dig in further, more, right? And they don't look for disconfirming evidence. They keep looking for confirming evidence to get more and more comfortable in what they already think. As an investor, your core competency is research. And so you have to do the opposite as an investor. You have to look for disconfirming evidence. You create a hypothesis. You say, look, I go to Dmart, and clearly they're like, an amazing business. Okay, there's a lot of these street stands that I think will this unorganized economy in India that will disappear over the next 10 years. Let's say you have that view, right? That's your hypothesis, and you think that Dmart is the lowest cost provider of groceries in India, right? So now you have to go look for disconfirming evidence, right? You have to go look for evidence that kills that hypothesis. What would you have to see in the research to think, oh wait, maybe Dmart isn't the lowest cost provider. Maybe these street vendors can actually sell for a cheaper price because they have lower labor costs and lower overhead costs or something like this. Maybe Dmart is already fairly saturated. Maybe there isn't that much growth runway, or maybe Flipkart will be the lowest cost provider, right? You have to think. You have to keep thinking about ways that you could be wrong. And the problem is, this is not a skill that's taught really in school, right? In school, you have a textbook, and then you have a test, and then everything on the test is from the textbook, right? And then in engineering, you have some curveballs, right? Engineering, math, physics, like you have something different that's not in the textbook, right? But it's still like you're not forced to think creatively. You don't learn how to think about a big problem and then just go and come up with solutions to solve it, right? So it takes time to kind of work that, right? Another thing to do is to focus on the fundamentals of the company. So I should have mentioned this in the what not to do bucket, right? So we're going to go back temporarily to what not. Another thing besides don't trade short term is don't drown in news, right? Don't be plugged into the news flow, right? Because that will just drive you insane, right?
News?
So, news, yeah. If you just read news all day, you're not going to be, it'll just drain you energetically, and you're just not going to have as much time and clarity of thinking to think about the business model. I mean, you should be aware of what's happening to the companies you're interested in, right? You should be aware of what's happening in those industries, right? But don't just get swallowed up in the news, right? Ultimately, you're trying to find a collection of companies that the market thinks will be, maybe 2 or 3 times the size of that the company is today in 10 years, but you think it's going to be 10 times the size in 10 years. Those are kind of the opportunities you're trying to find. Or you're trying to find companies that the market thinks are going to be half the size in 10 years, or they're going to be bankrupt in 10 years. you think, look, it'll be like 20% the size, or it'll just be like flat over the next 10 years. So you always, so you're the reason this game is difficult is because you have to find an area where a lot of other people are wrong. And that's tough. That's not easy, right? That's why the vast majority of money managers cannot beat the index.
Yeah.
And so your default should be to generally own the index, but if you have an interest in business and investing and research and things like this, these are kind of the things you should think about. Generally, like if you follow like Warren Buffett, Charlie Munger, right, Jeff Bezos, and you read the Amazon shareholder letters, right, and then you get those formulas down from Professor DeMorgan, and you'll see, like, as you read more, the more, like, your interest will grow. Like, the way to figure out if you're interested in this stuff is, you know, spend like a Saturday afternoon reading about investing or business. You know, if you don't notice the time passing by, this is something you're interested in, right? But if you're exhausted after 10 minutes, maybe it's not for you, and that's okay.
Yeah,
Okay.
ஸோ
Great.
எனக்கு டேஞ்சிபிளாக உங்கள் ப்ராசஸ், உங்கள் இன்வெஸ்ட்மெண்ட் ப்ராசஸ் சொல்லித்தர முடியுமா? லைக் பேசிக்கலி இப்படி தான் நீங்கள் ஐடியா ஜென்ரேட் பண்ணுவீங்க, லைக் மேபி சம் வெப்சைட்ஸா, இல்லை எப்படி நீங்கள் புது ஐடியா ஜென்ரேட் பண்ணுறீங்க, அதுக்கப்புறம் இது பொட்டன்ஷியல் ஆப்பர்ச்சுனிட்டின்னு எப்படி பர்சியூ பண்ணுவீங்க அந்த ஐடியாவை, அண்ட் தென் லைக் வாட் ஆர் த டூல்ஸ், லைக் பேசிக்கலி, அண்ட் தென் லைக் நீங்கள் ஃபார்முலாஸ் கூட மென்ஷன் பண்ணீங்க, லைக் வாட் கைண்ட் ஆஃப் ஃபார்முலாஸ், லைக் எக்ஸாக்ட்லி வாட் கைண்ட் ஆஃப் ஃபார்முலாஸ் சொன்னால் லைக் மேபி it could be a better starting point for us. நீங்கள் ஸோ அந்த ப்ராசஸ், அந்த டூல்ஸ், how it works for you ன்னு கேட்குறேன்.
We would need like like several hours to go through everything in detail, right? So I would have to give you like an abridged, a shorter version. Okay, so we'll start with idea origination. Okay, so the most important thing with idea origination is to have a community of other smart investors. So I forget if it was, I should really look this up. This is like the third time I'm saying this. It was either Peter Lynch or Phil Fisher, two very good, respectable, wonderful, smart investors from the US. One of them said something like, out of 5 really good, successful investments I had, I only came up with one of them. The other 4, it was either 4, 5, or 6. The vast majority came from other smart investing friends that I had, right?
Yes.
So it's very important to have a community, right? So, and nowadays that's like, it's so easy to do that. You know, you can go on X, you can go on Substack, you can go on YouTube, you know, there's so, even on Instagram now I see investing content, right? So there, and there's lots of communities on Slack, on Discord, right? And so even if you don't have investing friends in your circles now, you can go online and start to kind of engage with people and start to kind of plug into other communities that are out there, right? So that's the most important thing for idea origination. The next thing is to actually originate your own ideas. It takes a while, right? So there's like lots of books you have to read about the general investing frameworks, and then you have to learn accounting and valuation and how to analyze business models, all these things. And while you're doing that, what I would suggest is to read investment write-ups of other investors, like great investors, right? So you can go to the 3 websites I recommend for that. 1 is Value Investors Club. 2 is Scuttle Blurb. That one is a paid membership, but he has some free ones on his website, okay, that you can sample. And the third one is Substack. So if you go to these 3, and obviously an X on Twitter, right? So there's a lot of like smart investors that share their investment write-ups, like the reason why they think a particular stock is good to own, right? And as you're reading these investing books, you should also read these examples, right? And basically get what I call synthetic reps from these other smart investors that have already done the research, that are further along, right? And then as you become better and better, you'll learn about different industries. Then you can start to originate your own ideas, okay? And the reason it's really hard to originate your own ideas, okay? So, and they come from all sorts of places, right? Like the classic way to originate your own ideas is to run what's called a screener.
Yeah.
So you can go to various websites, like the one that I use is ticker.com, TIKR.com, and it's global, right? So it has Indian stocks, American stocks, European, every country, right? And you can filter out companies based on the market cap, how fast they're growing, the margins, what country they operate in, the valuation multiples, these kinds of things, right? And you have to learn how to run like a good screener, right? Like, so for example, right now, there's a lot of very cheap companies in Japan. Why? Because historically they have kept a lot of cash, excess cash on the balance sheets, and they never really gave it back to shareholders through the form of dividends and share repurchases. And that behavior in corporate governance is starting to change in a very big way. Right? There's a lot of pressure from the Tokyo Stock Exchange and even from the new prime minister to be more efficient allocators of capital, right? Because Japan has kind of a challenging demographic environment, right? They have an aging population, the household formation is not so good, right? And so they need to attract more and more foreign investment, and in order to kind of save their economy, over the next 20 years, like the situation is actually quite dire in Japan right now, right? And so in order to do that, they want to allocate capital more efficiently, attract more foreign direct investment. They're encouraging more immigration, right? And so that's like a big theme that I kind of just know about from exchanging notes with friends. It was actually the mentor of mine that got both my jobs that told me about this like several years ago. But that trend is like continuing now, right? So because I know that, I'm like, okay, and a similar thing is happening in South Korea, right? So because I know that, I'm like, okay, I'm going to run a screener for companies in Japan or in South Korea, right? And then I'm going to have the screener sort by industry, and then I'm going to have the screener show me the valuation multiples, and then I'm going to sort it, and then I'm going to stack all the industries, right? So I want to see all the healthcare companies, all the software companies, all the trading companies, right? And then I'm going to see all the valuation multiples, and then I'm just going to like click through, see what's interesting, right? So this part is really difficult, right? So what I do next is I set a 5-minute timer, okay, to make a determination if so I'll spend 5 minutes and I'll go through like 100 companies or 200 or 300 or 400 companies, okay? And what I'm trying to decide is this worth spending 10 minutes on or not, right? So I'm very quickly trying to say no, right? Like if I find a company that's already kind of, like I'll just give you an example, right? Like, a company that's already kind of efficiently out, there's no excess cash on the balance sheet, no excess investments on the balance sheet. And the company is at like some sort of cyclical high, like I don't know, it's in like the manufacturing industry or something, and this industry is at a cyclical peak, you know what I mean? And I know that it's gonna, at some point in the coming years, it'll go to a cyclical trough, and it's already trading at like a peak multiple on peak earnings. That's not so interesting for me, right? Okay. Maybe I might try to like short it or something, right? But generally I don't really short, I'm like long only. Or if it's an industry I don't really understand, right? I'll skip it, right? And then if it passes the 5-minute test, then I'll spend 10 minutes. And then if it passes the 10 minutes test, I'll spend 30 minutes. Yeah. And then an hour, and then half a day, and then a full day, and then a week or so looking into the company, right? That's how we did it at the family office where I worked, right? So the reason that's really difficult is because you have to know you have to have good pattern recognition. Yeah. Right? And that takes many years to build. Yeah. Yeah. Right? So you can't just go like straight into it. I mean, you can, but like for me, it took me like 5 years and 10,000 hours, like deliberate hours, before I was comfortable kind of making my own investments, right? And that involved being in investing organizations, having all these mentors that worked at all these amazing firms in New York City, reading all these books, taking all these classes. I mean, I was a finance and accounting major as well, right? Working at like interning at two different hedge funds, working in investment banking, and then I slowly things like started to click. When I got to the family office, and then my former boss was like my main mentor, right? Like I graduated 6 months early college, so then I spent 6 months just like reading and thinking in my apartment in New York, and I learned more in those 6 months than 3.5 years at school, right? And then the first 6 months on my job, I learned more than the first 5 years, you know,
Yeah.
as a student, and also, um,
Practical experience.
as an investment banking analyst, right?
Yeah.
Because I had such a good mentor, right? So it's like having a good mentor, a good community, that goes a really long way, so that you don't end up wasting many years going in like the wrong direction, right? Like if you find the right framework early on, it'll really accelerate the amount of time it takes you to be a good investor. The other thing is just like when it comes to investing, just think about as if you own the company privately, right? So there's so many business owners that are amazing business owners. They've grown and scaled their business, but then the moment they look at a stock, which is just another business that happens to be publicly traded, suddenly it shifts from business analysis to gambling, right? To speculation, right? So if you can like get over that kind of barrier, that obstacle, and think the way that a private business owner would think, that would be, that's really key, right? And so then once we find an interesting name, the way we do research is just in the beginning, you formulate a hypothesis, right? Like you think, okay, in the first 5 minutes, like what's the best case scenario for this? Like first there's like categories of different companies, right? Fast growing companies, slow growing companies, low cost companies, right? Brands, right? So there's like lots of these categories, these buckets, this pattern recognition, right? Like I'll share with you like a reading list that you can send to your audience, right? Like a comprehensive reading list, right? Like Peter Lynch, he has like 6 or so, I think, categories of different types of companies, right? So the moment you like look at the financials and the description, you should be able to spot like, okay, this is like this belongs in this category, and then like, okay, in this category, generally this is what needs to happen, right? Is this a turnaround? Is this like a high growth disruptive company, or is this like a slow growth company? Is this a cyclical company, right? And so you have to have those pieces of pattern recognition, and then once you start doing the research, you have to formulate a hypothesis, right? You have to be like, okay, best case scenario, what could happen for this company? And then you're like, okay, best case scenario, I could get a 10% return over the next 10 years. So, generally that's not going to be so attractive, right? It also depends on how cyclical the company is, right? Like the beta of the company, right? But it's just assuming it has like somewhere close to a beta of 1, 10%, you're like, okay, that's like okay, but like not great, right? And then in another company, you say, okay, like best case scenario, it could be a 30% return over the next 10 years. Like, okay, so that's interesting, right? So then you go in and you think like, okay, what is the probability of that happening? And then what's the downside case and what's the base case, right? So you have to think probabilistically, right? You have to think like, okay, there's like a few different ways the world could unfold for this company. So what are those different scenarios, and what's the probability of those scenarios? And then what's my risk reward, right? Like ideally you want to find a situation where it's like you flip a coin, where heads you win and tails you don't lose much, right? Those are the kinds of situations that you want to follow, or that you want to invest in.
Trying to learn as a student from you, like this is how my process works. So recently started knowing about this third in your filings, and I created a video as well for it. Like I learned a lot from your videos. Don't mind me if I added some points from yours as well, because I found it
great, of course,
very useful, and I wanted to share with everyone. So
of course, yeah.
Yeah, this is how my process starts. Like I just go to 30 new filings from Data Roma or Whale Wisdom site, which you mentioned in one of your videos, and then I
Yeah.
start from there, and then I go to insider transactions. I see that as a very strong point. Just comment on it if you find it useful or not. If I
Yeah.
see the operators buying in large chunks, I see some large value in it, and I raise the same question to you last time as well. Like the company would not have reached profitability at all. It would be in They would be making losses, but EBITDA and revenues would be in positive, but net income would be in negative. But then you said it could be because of margin. So this is how my process: 13 filings, idea generation, and then like insider transactions, and then like numbers.
I mean, yeah, I like your framework to find the 13F filings, and then cross-reference that with stocks where a lot of insiders are buying. I think that's good. Um, it might leave out companies where the insiders already own a lot of the stock, but they haven't bought like recently, right? So then you'll miss out on those companies,
Okay.
right? With that framework. But in terms of formulas, the main thing at the end of the day is annual returns, right? So it's hard to explain this without like having like a visual aid, but generally the returns you own that you will generate in stock come from three places: the dividend yield, the earnings per share growth, and the change in the entry and exit multiple annualized over the holding period. Okay, so let's keep it simple, and let's say you're looking at a mature business that you don't think the multiple will change so much. Okay, so then your returns will generally be your dividend yield plus earnings per share growth, right? And the way that math works is like the stock price is the earnings per share, right? And sometimes the GAAP earnings per share that's like reported is not the actual earnings per share. Like, so you have to think like what's like the economic earnings per share. Like sometimes, there's like that's like a complex topic, but just something to keep in the back of your mind. Like sometimes the reported number is not actually what the company can really do. Okay, if they do a lot of acquisitions, there's like an amortization tax shield that'll make the earnings per share look lower, but actually the adjusted earnings per share will be much higher, right? So the stock price is just the earnings per share times the PE multiple. Okay, today, right? And then some portion of that is paid out in dividends, and then some portion of that is reinvested in the company at a certain incremental return on equity to grow the business, right? And then in 5 years, the stock price will be the same formula, right? It's just the earnings per share times the PE multiple, right? So in 5 years, so right now, if the company does like $5 in earnings, and you think in 5 years, they'll do $10 in earnings, right? And the multiple stays the same, and the stock doesn't pay a dividend, you will have doubled in 5 years, right? And that's roughly like a 14% return, right? So that's how you should think about it. It's like, okay, this is what the company is earning today. This is the valuation, the multiple it trades at today. What do I think the earnings will be in 5 years, and what do I think the multiple will be, right? So then when you're looking at like a high growth stock where the margins might look low today, right? You have to think like, okay, what do I think the margins can get to in 5 years, in 10 years, right? And then you have to think like, okay, like where's the growth coming from? Are they adding new products? Are they acquiring other companies? Are they growing their market share, right? Peter Lynch is one of his great successes. I don't know actually if it was one of his successes or one of the successes he studied, but one of them was Walmart, right? Like if you studied Walmart, many decades ago when they were like in the 70s or something, in the 80s, it was a much smaller company. but you could see that the returns the company was earning on every location that it added was very high, right? And so they were like destroying these variety stores in all these little towns, you know? And in the towns that they did operate in, right, originally in Arkansas, and as they expanded, they had a very high local market share in those towns. So it's very difficult to compete with Walmart. You know, you'd have to get like a very high market share just to break even on your fixed costs to compete with Walmart. So then you would think like, okay, how many more towns can they add locations in? And then like within the towns that they're already in, this is what like GDP growth is, you know, so the stores will continue to grow. And then they in the locations they're already in, they're at this market share. And I think they'll get to this market share. And then they add all these new towns, right? So then you get some idea of the growth, and then it'll cost you a certain amount of capital to get that growth, you know? And so if you go through the Demoteran's course, you'll understand like how to tie all those things together, right? Like, because remember, like growth doesn't come free, right? Like it requires capital, right? Unless you're just increasing prices, but then that also has to stop at some point because you can't just keep increasing prices forever, right? So that the Professor Demoteran will do. He does a good job of like tying all that stuff together, of like what it takes, right? So to your framework, right? Like what I would do instead is just go to ticker.com and look at the business summary, like try to quickly understand what the business does, how it makes money, what problem it solves, and then you look at like, okay, what's the valuation, like what does it trade at, right? What do I think it can grow at for the next few years? Are they earning a normalized margin, right? Is the company's current margin what it's going to be over the next 5 to 10 years, or is it going to get lower than it is today, or is it going to get higher? Right? It really just comes down to like growth, margin, and then you get your EPS, and then you add the dividend yield, and you have the growth, and then you have the returns, right? But to actually walk through the formulas and all that, I would have to do like a screen share and kind of
In that case, like I'm still learning from your video, so keep posting your video. So anyone who is really interested in this stuff, like, will go to your channel and we'll learn about the technical stuff. So thank you so much for that. And one next question is about portfolio management. Like, do you have any hard limits on a stock not crossing 10%? Or some of my friends saying that, like, even when I showed my portfolio to you, you said like 50% on a mining stock is like too much. So how do you construct a portfolio?
It's like an art and a science. So I don't have any hard rules in terms of just, like I don't let something go above 5% or 10%.
Okay.
Obviously, right? Like I have one stock in my entire net worth, right? So, and of course, and I also manage my parents' money, and for them, obviously, not everything is in one stock, but they have, I think, like 8 to 10 stocks, and plus the equity in their house is kind of what their net worth looks like. And so I think big picture, you should just own like a collection of businesses. It can be 5 to 10 or 15 to 20 based on what your kind of volatility appetite is. Anywhere from 5 to 20 stocks of businesses that you would just close your eyes for the next 10 years.
Okay.
Right? That you just think that have like a very bright future for the next 10 years, where you feel that you can't lose a ton of money. There's a lot of downside protection, both in the business model and the price.
Okay.
Right? Because risk doesn't just come from like the business model, but also from the price you pay. And where there's like some potential for upside, right? And like you said, you can look through lots of 13F filings, and there's lots of, feel free to share kind of that Excel file of all the world-class investors, and you'll have plenty of companies to look at. But I would give yourself some time to like read the books and read other people's write-ups and stuff before you really start to like deploy your own capital. You know, like until then, I would try to, you know, own the index or kind of, you know, do some less concentrated strategies, right? And generally, like if you find a winner, like, you know, you should just let it ride, right? You should continue to own it until you think the next 5-10 years returns at this price are not as attractive anymore, right? So that's generally when you should sell, or you should sell if you're wrong, right? Like if you thought the company was like great, and then like a year or two into owning the stock, the company, you know, is subject to a lot of competition and the economics of the business erode. You have to kind of revisit and potentially sell, right? But generally, like if you find a long-term winner, my philosophy is to continue to own it until you think the going forward returns based on what you think the earnings and the multiple will be over the next 5 to 10 years is not so good, right? Or another reason to sell is you find like another phenomenal company, right? Like if you own 10 stocks, okay, and then you find another one that's like really attractive, you look at like the least attractive stock you own and maybe there's still decent returns, but you found a more attractive opportunity, right? So that's another reason why you should sell and kind of, but I wouldn't over diversify, right? Like I wouldn't own more than like 20 stocks, right? Assuming you've done all the more than 20.
20,
Because the benefits of diversification really start to taper off. And remember, like in your 20s, like you should be taking risks, right? Like that's the time to take risks. That's why I quit my job when I was 25, 26, right? But I had a lot of money saved up from my 2 jobs and the performance of my investments, right?
So it's been
But that was that.
4 years.
Yeah,
So it's been
almost 5. I quit in March of 2021.
okay.
Yeah, so I've been a bum for 5 years.
Okay, like any books in terms of investment that made a deep impact on you, or like that clearly explained, like some of my favorites are the One Up on Wall Street and Most Important Thing by Howard Marks. I like them so much to the core, so I follow every memo. So similarly, like because I'm not a finance person, so they help me to understand the core of finance in very layman's terms. So similarly for you.
I'll give you a giant reading list that you can share with your subscribers. But those are 2 wonderful books. Both of those books I read early in my journey as an investor, and I don't think I've actually ever read One Up on Wall Street. I think that came much later. I think I read Margin of Safety by Seth Klarman and Most Important Thing. Those were like the 2 that I read. But I would recommend One Up on Wall Street more than Margin of Safety. So those are 2 wonderful books. The thing is, those 2 books don't really teach you how to analyze a business model, right? So the book I would recommend for that is Competition Demystified by Bruce Greenwald. And, you know, he's not right on everything, right? There's no investor that's always right? Like he was bearish on Apple, you know, like 20 years ago. Obviously he was wrong, right? But there's a lot of great frameworks he talks about Walmart, you know, in the book. So I would recommend Competition Demystified and The Outsiders by Will Thorndike. So those 2 books will really help elevate your game. But I'll share with you like a much more comprehensive reading list.
So about tax, any words about tax? Like see, like once you make a good profit in your investments, like now I'm kind of in a position not to sell them. If I sell them now, I'll be liable to pay a lot of taxes in the coming February and March. So did you face any of the issues with taxes before?
Yeah, I mean, if you own, I don't know how the regulations work in India, but in the United States, if you own a stock for more than a year, that's like the difference between long-term gains and short-term gains, right? So as long as you're in the long-term gains, the tax rate is actually not that high. You know, I think it's like 0 to like 20% depending on the dollar value of the gains that you have, right? So that's another reason why you should be a long-term investor, is for tax purposes. And it's another reason why you should favor companies that have a lot of opportunity to reinvest in the business and grow, because a company can reinvest in the business on a pre-tax basis versus a company that just pays out a bunch of dividends, right? And dividends are like tax inefficient. You have to pay taxes on dividends, right, as an investor. So that's why I tend to favor companies that can reinvest and grow. And another tax efficiency is to have a retirement account that's tax sheltered, right? So as early as you possibly can, get that started and start maxing out the contribution, right? Like a lot of times your employer will give you like matching, like, you know, into 401k. And so you should absolutely take advantage of that and just keep kind of contributing every month. And, you know, your future self will be very grateful.
Yeah. Any specific ideas for people in India or Indian markets? Like I've been suggesting them like move your at least like hold like 50% of your position in the US. It gives you like market diversification as well as the dollar hedge. Dollar is still the most powerful currency, so
Yeah, I think, look, like, don't, you know, hold me to this like financial advice. But one thing I might consider, right, is to put, I don't know, like half the money in the S&P 500 and half in the MSCI emerging markets index. So you'll have exposure to like China, Taiwan, India, right? And that way you're diversified across country, currency, and you know, I think over the long run you should do okay. You know, somewhere in the range of like 8 to 12% returns over many years. Right? The thing is, you don't want to stay out of the United States. Like, you definitely want some exposure to the United States, but the fiscal debt situation in the United States right now is like very dangerous, right? Like the dollar is down 10% this year versus kind of a basket of other major currencies, right? Like that hasn't happened since the 70s, right? So I think investors, particularly central banks, are starting to shift away from the US dollar. And so what has been like a tailwind for the United States over the last many decades, right? Over the last like 30, 40, 50 years of a strong dollar might be reversing, right? So, and that's why I'm saying, like, you can never know for sure, right? But there's like this risk of that. And so I think that's why you should have some exposure across other countries. But it's like the most dominant companies in the history of capitalism so far are in America. So it's good to have that exposure. And ideally, you're just buying more of those two indices every month.
The other question which I had was like about the passive money that you get on a recurring basis, on a monthly basis to live your life. So even if your investments on one side is holding really like doing really good, but when you're planning to retire, so you need monthly payments, right? So how do you manage that? Like, have you invested in any of like treasury bills, bonds, or how do you do it?
Now, the way I managed that historically was, again, I don't recommend this to people, right? But because, again, my cost of living was so low relative to my net worth, I would just borrow against my shares. And so, because Carvana doesn't pay a dividend, right? So as long as the debt to the value of the stocks was less than like 10%, I could kind of fund my life doing that. But recently I sold a large amount of covered call options against my Carvana shares in my brokerage account in order to generate cash and basically pay down all my debt. And depending on, because they don't expire until June, so depending on whether the calls expire worthless, in which case I get to keep the premium and my shares, or if the shares, or if my shares, I'm forced to sell them at the strike price, right, in June of next year. Depending on that, I will adjust kind of my strategy. And so I think I just did the kind of the reverse math of what my kind of dividend yield after taxes needs to be in order to fund my life. So I'll construct next summer, if I have to sell all my Carvana shares, like a portfolio that pays a dividend. But I would prefer to own dividend paying stocks over bonds right now, because I don't think there's as much risk in like short-term treasury bonds, but with long-term bonds, there's significant risk of like dollar debasement and like inflation rising, and especially with all the tariffs and stuff that are going to start rolling their way through the economy, and also with if the dollar really strongly becomes debased, then the interest rates in the United States will rise, right? And so it's very risky actually to own long dated U.S. Treasuries. In fact, buying out of the money puts on long dated U.S. Treasuries would be good portfolio insurance, and that's what I've done in my parents' portfolio. Because if rates rise sharply, longer duration bonds will go down much more steep, like much more than like shorter duration bonds.
Okay. Look, sounds technical to me, because like options, put and calls, like I don't know how you handle this, but for me, like the thing that resonated with me was either the dividend paying stocks, if not like T-bills, like treasury bills, like that gives me like even 3% for me is fine to manage my
Yeah, as long as they're short-term treasuries, you're okay,
Yeah.
But the ideal thing is to own a cash flowing business.
Okay.
That
You
is
can sell
like
some
the
stocks.
highest. That's the high. Yeah, you can also sell stocks, but the highest yield you'll get is to own a private small business. That would be the best like yield on your investment.
Okay.
Yeah.
Okay. And I don't know if I can ask you this question, but like at what point, or like beyond maybe like a financial figure beyond which you can think about retirement, like, or that triggered you to think about like, okay, now it's a point, like it's your call, like maybe you can answer it or you can decline it, like.
Yeah, no, it really comes down to that metric, right? Your annual cost of living divided by your net worth. And, if you like, if depending on whether you want to start a family, you kind of make some forecast in the future of what your cost of living will be for you and your family, and then you kind of compare that to the net worth you have right now. And as long as, you're below like 5%, that means that your investments only have to generate a 5% yield for you to cover your living expenses, right? Like initially, I didn't do that math. Initially, it was just like, I have this much money and I can survive for like 5-10 years. I'm going to take a leap of faith and bet on myself and go travel and, experience all these things that I haven't, because, I worked really hard in high school, like in college and at work. And I didn't really have like any travel adventures. And so I wanted to do that, right? And it was like the 20s are your best time to do it. And then, Carvana crashed, right? And then I almost had to go back to work, and but I was in a 3-month meditation retreat. And then when I came out, Carvana was like way up again. And so I was like, okay, cool. Like, I guess I'll have some more time. And then it really went up, so, and then, I was like semi-retired, I guess, at like 25, 26. And then now at 30, it's gone up so much that, I think I'm like comfortably financially free. But it really just depends on those two numbers, right? Like how much money you have versus how much are you spending, right?
Okay.
And if you have good work experience and you want to just like take a sabbatical, if you have like 3, 4, or 5 years of runway, you can take the risk, right? As long as you're confident that you can get a job again, or you can start a company to eventually get you down to that like 3, 4, 5% number, right? That basically like your net worth should be like 25 times your cost of living,
Yeah.
right? If you can do that, then like eventually like you'll get to a point where your investments will compound more than like your cost of living.
Yeah.
And then once you reach that escape velocity, it's like the power of compounding is just magical.
Yeah.
You'll get to a net worth level by the time you're 50, 60, 70 that'll make your head spin.
Yeah. Do you think like as an average American or a person who's in any part of US or in India, like I heard from the radio that day, like they said like if you are okay living in the East Coast somewhere in the regions nearby like North Carolina, like 1 to 1.5 million should be enough based on the current cost of living expenses. What would you pay? Like the rent won't go beyond like 1600 if you're living in a very small town, or just comment on it if that's the right number. And the second thing is, which I've heard is, which I really liked about is, it's not the money, but the skills that you have. Like as you said, like if something happens to Carvana, the stock or the investments that you have, you can just go back with the same amount of skills that you have, so you can get the same job. So that I think you will agree. But comment on the figure as well, like 1 to 1.5 million.
It depends. It depends on your personal situation, right? Like if you have like a severe like health condition and you need like a specific insurance plan, then those figures are not very helpful, right? Like you have to take ownership, like you have to do the numbers for your own life. Like you have to do it for yourself and see like, okay, what am I actually going to be spending every month on rent, on groceries and things like this, right? And then you come up with a forecast, and then it's the same thing when you work at a company, right? You have a budget, and then at the end of the year, you compare what actually happened to the budget. And if there's a big difference, you're like, okay, like what happened, So you have to kind of create that habit of calculating your expenses and tracking it. And there's lots of personal finance apps, on iPhones and Androids that'll help you do that. But I would create your own forecast. I wouldn't go with those numbers. But yeah, generally like $1 million is a fair amount of money, right? As long as you can keep your expenses low, right? Like as long as you can live on less than $50,000 a year and you have $1 million in savings, that's great, right? And $50,000 would come out to what would that be per month? 60,000 would be 5,000, like 4,000 a month, roughly, a little more than 4,000 a month, right? If you have 50,000 of expenses per year, so you have to check, right? Like if your rent is, like you said, 1,600, right? That leaves 2,400 a month for your other expenses, right? You have to think like, okay, do you have kids? Are you single? Are you married? Right? Like how often are you going to restaurants? Right? How often are you traveling? Things like that. Like what's your car insurance? What's your health insurance premiums? Right? How much of that is your employer going to cover versus you have to pay out of pocket? Those kinds of things. You have to kind of run the numbers and take ownership of your personal finances. That is the main thing.
Got it. So I'll just ask some couple of rapid fire questions. Maybe you can just answer with yes or no or whatever. It's like qualitative or quantitative analysis.
Both.
Focusing on only particular business area like oil and gas, or where someone has a lot of interest or they have a lot of knowledge, or like go into different business. It doesn't matter. It just depends on the company and whatever business it is. Like which one do you prefer?
Try to be a generalist. It takes longer. It's more painful, but it's worth it long term.
Got it. Any AI investments?
Any what?
AI, artificial intelligence investments. Do you trust?
Yeah, like in my parents' portfolio, we own Google, Amazon, Meta, and Tesla.
Yeah, I think that's the questions I had. Thank you so much, Akshay. Like, sorry if I squeezed you with a lot of. I just want to get a lot of insights from you, and
No worries.
I'll link your link to the LinkedIn profile, and then like your Instagram account, and then like maybe your YouTube channel, as well as your Calendly link if you give me permission, so that I'll link there, so that like maybe because I feel strongly believe like people from India, like especially in the South, they're not that well aware of finance and what they could do to retire early, or like strongly pursue their passion or inner calling. So I'll just yeah, if you can help them, like it'll be of great help to them, so that maybe I'll link your profile and everything. So and one kind request is, please post videos, even though not many for now, like people like us, like I really wanted to learn the technical stuff. Like I've been reading books, like qualitative analysis fine, but like quantitative, like only person like you could teach, because you have a lot of experience in it. So yeah, I think thank you so much, and thank you so much. That's what I can say.
Yeah, of course, man. I'm actually, so the Calendly calls, I'm gonna pause them for now because today I agreed to go work for to write for a digital marketing company. So I really want to improve my writing skills. And so whatever's already been scheduled, I think I have like 20 calls left. Like I'll do those. But for now, I'm going to pause the Calendly. So I think the best way to kind of reach me would be like Substack. That's where I'm like most productive. And I think on the Substack it has like all my other links, like LinkedIn and YouTube and X and stuff. Yeah, and then I'll share with you my reading list. But yeah, it was an absolute pleasure. I loved our conversation.
Thank you so much, Akshay. And finally, I want to complete this with Tamil. Like, ஏதா தமிழ்ல சொல்லுங்க, Tamil audiences-க்கு. And we'll close it off.
என்ன தமிழ் ஆடியன்ஸ்க்கு என்ன சொல்றது?
If not,
உங்களுக்கு உங்களுக்கு இன்வெஸ்டிங் பண்ணணும்னாக்க கொஞ்சம் படிக்கணும். இது வந்து இந்த கேம் வந்து மனசோட கேம் இது வந்து. அண்ட் உங்களோட மனசை உங்களால் கண்ட்ரோல் பண்ண முடியும்னாக்க யூ ஹேவ் இன்வெஸ்டிங்கில் கொஞ்சம் சக்சீட் பண்ணுறதுக்கு சான்சஸ் இருக்குது. ஆனால் if you மனசை கண்ட்ரோல் பண்ண முடியலனாக்க இன்வெஸ்டிங் ரொம்ப கஷ்டமாக இருக்கும்.
Yeah. Thank you so much, Akshay. On that note, we'll close it off, guys. Like, hopefully you guys would have enjoyed this conversation. I really got a lot of insight from this personally. So yeah, thank you so much, Akshay. Meet you next time.
Of course, man. Much love. Until next time. See you.
See you. Bye-bye.